All right, let's get right into it. Over the next few minutes, we're going to break down the 10 financial concepts you absolutely have to know. Seriously, getting these right is the bedrock for building a secure financial future. So, let's jump in.
Because that's really the big question, isn't it? The whole point is to go from feeling stressed about money to feeling confident. And this right here, this is your roadmap.
You know, to make this whole journey feel a bit more real, let's follow a guy named Chandu. He's feeling something a lot of us feel, a little overwhelmed, kind of worried about what's next. He knows he needs a plan, but honestly, he has no clue where to even start. Okay, so this is it. Step one for Chandu, and for you, is just figuring out where you are right now. I mean, think about it. You can't map out a trip to a new city if you don't even know your own address, right? Same thing with money. And that starting point, that you are here pin on the map, that's your net worth. Think of it like a personal financial report card. It's not about how much money you make, it's about what you have versus what you owe. It's the best single snapshot of your financial health, period. And the formula? It's beautifully simple. It's just your assets minus your liabilities. Assets are all the things you own that have value. You know, cash, investments, maybe your car. And liabilities? That's the stuff you owe. Student loans, credit card debt, that kind of thing. Chandu does the math and boom, just like that, he knows his starting point.
So now that Chandu knows where he stands, he has a bit of a realization. He's kind of exposed. Before he can even dream about growing his money, he needs to build a defense, a shield, against all the curveballs life is definitely going to throw his way. And the very first layer of that shield is insurance. Here's the thing about life insurance. It's not really for you, it's for your loved ones, to make sure they're taken care of if the worst happens. And health insurance? Absolutely crucial. It stops your savings from getting completely wiped out by one unexpected medical emergency. Chandu gets these sorted, and you can just feel him breathe a little easier.
But then, a new thought pops into his head, a new worry. Okay, insurance covers the huge catastrophes, but what about the smaller but still pretty awful financial shocks? What if his income just stops?
And that is exactly where the emergency fund comes into play. This isn't an investment, it's a financial cushion. It's cash that you've put aside for one reason and one reason only, to get you through a crisis without having to dive into debt or, even worse, sell your investments at the absolute worst time.
So the big question is, how much do you need? Well, the rule of thumb is about 6 months of your essential living expenses. So for Chandu, let's say his non-negotiable bills add up to 50,000 rupees a month. That means he needs a goal of 3 lakh rupees saved up. Having that concrete number gives him a real target and a huge sense of security.
All right, so Chandu's personal defenses are up. He's got his shield. Now it's time to look outward. He's got to understand the big economic forces that are always, and I mean always, pushing and pulling on his money.
The first force is something called liquidity. And that's just a fancy way of saying, how fast can you get your hands on your money? For an emergency fund, liquidity is everything. You need that cash to be available immediately. That's why it's usually in a savings account, not tied up somewhere you can't touch it.
And next up, we have the silent wealth killer, inflation. You know how a basket of fruit that cost 100 rupees last year suddenly costs 120 this year? That's inflation doing its thing. It just means that every single day the cash you have sitting around is slowly losing its power to buy stuff.
And this brings us to a massively important rule. To actually build wealth, your investments can't just make money, they have to make money faster than inflation is eating it away. Think about it. If inflation is, say, 5.5%, but your investment only returns 4%, you're actually going backwards. You're losing buying power. So, armed with this powerful knowledge, Chandu is finally ready. It's time to switch from playing defense to playing offense. It's time to step into the investment arena and actually make his money start working for him to beat inflation and build some real wealth.
Now, when you start investing, you'll see returns are all over the place. Up 20% one year, down 7% the next. So how do you actually compare one investment to another? Well, you use something called CAGR, or the compounded annual growth rate. It basically smooths out all those crazy ups and downs to give you one simple average annual growth rate. It's the perfect tool for an apples-to-apples comparison.
Now, investing isn't just a straight line to the moon. The market moves in cycles. You have bull markets where everyone's optimistic, confident, and prices are on the rise. And then you have bear markets where fear creeps in, pessimism takes over, and prices fall. Just understanding that these cycles are a totally natural part of the game is key to staying calm.
But here's where it gets really personal. How do you feel during those down cycles? Your risk tolerance is your gut-level ability to handle the volatility. Can you actually sleep at night if your portfolio drops 20%? Answering that question, knowing if you're aggressive, moderate, or conservative, is something you have to do before you invest a single rupee.
Okay, deep breath. We've talked about personal defenses, big economic forces, and the tools you need for investing. Now it's time for the final step, putting all of these pieces together to craft a single, powerful master plan.
I mean, come on, you've heard this a million times, right? And there's a good reason for that. It is one of the most powerful, most timeless ideas in all of finance. And it leads us perfectly to our final big concept. Asset allocation. That's the fancy term for actually following the don't put all your eggs in one basket rule. It's the simple strategy of deciding how you're going to split your money up between different kinds of investments, like stocks for growth and maybe bonds for a little more stability.
And this is what it can look like in real life. By spreading your money out across these different categories, you lower your overall risk. Why? Because when one part of your portfolio is having a bad day, another part might be having a good one. It smooths out the ride. This is how you build a portfolio that can weather the storms long term. And just like that, look at Chandu. He started this whole thing feeling worried, uncertain, totally lost. But by taking the time to understand these core concepts, from net worth all the way to asset allocation, he's turned that anxiety into an actual plan. He's not worried anymore. He's confident. He's in control. Look, Chandu's journey, that's your roadmap. You now have the fundamental building blocks to get started. The concepts are clear, so the only real question left is, what's your first move?